So as I spent more time looking at these different platforms, it quickly became apparent that there's a lot of different ways to make money. And different platforms make money in different ways. So the very first thing that I found that was the most important thing was understanding how each platform does make money. And it can cover a wide variety of things. Some of the platforms, especially in the Regulation D deals, the standalone deals, they like to act as just standalone marketplaces, and they take a cut from transactions. So when you invest your $25,000, they might take a quarter of a point, and they'll charge the sponsor $10,000 to list that deal in their marketplace, and then they take a cut every year. But then they might market it to you as being no fees. Well, you don't pay fees, but the sponsor does, so it affects your capital. And so it's really, really important to follow the money and understand how the platform is making money and whether or not and how it is aligned with you as an investor.
You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Wollard. I'm an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. I'm really excited to have Jason Hall with me today to talk about real estate crowdfunding. We felt it was important to do a deep dive on this topic because there's a lot of questions about how people can invest in crowdfunded deals. If you're like me, you've probably seen or heard ads for Fundrise, Realty Mogul, Rich Uncles. There's just a bunch of them out there. And there's so much excitement about real estate crowdfunding. And I think it is exciting, but I also think it's important to kind of cut through the hype a little bit, and that's what we're going to be doing today. So you've probably seen crowdfunding out there. It's essentially a way for people to pool their money together to do something bigger that they probably couldn't do on their own. So we've seen it in everything from GoFundMe, direct to consumer brands. They're launching like a cool startup, or like we saw with the Pebble Watch or things like that. In real estate, it usually is that you're contributing to purchasing a building or development, possibly something under construction. So now I'm going to turn it over to Jason. He's done many of our crowdfunding reviews on Millionacres, and you can see those on millionacres.com. He's very analytical. He's no holds barred, and he's really kind of cut through some of what these platforms are saying and really gotten to the meat of it. So hey there, Jason. How are you?
Hey, I'm really excited to have this conversation. One could say I might even be a bit of a firebrand on this topic. It's really interesting, right? I think one of the things that a lot of times people hear the term crowdfunding, and there's kind of been a shift in the way people think about it, right? Crowdfunding for a lot of people now is like, this is how you give money to causes, right? And the reality is that it started out as a mechanism to allow people to invest in things they might not have had access to in the past. And commercial real estate is as a prime example of that. This isn't giving money to a good cause or just to develop a cool product, and you might get some neat freebies as for helping fund that product. This is you're investing in real estate, hard money loan to a developer, or you're going to own an equity stake in the property. And there's lots of regulation that affects it, and it's kind of the Wild West right now. There's a ton of entrepreneurs that have jumped in on the developer side. Some have real estate backgrounds, some don't. So it's really important for investors to understand what's going on before they risk any capital in this space.
Right, and it's relatively new, so it's still something that's definitely being worked out. But I know that one of the things in the legislation is that there are two main types of crowdfunding. So there's Regulation A and Regulation D. Can you sort of break down those for our listeners?
Yeah, and the best way to think about it is that these different categories are based on different classes of investors. You have accredited investors, which the SEC defines as someone who meets one of the following classifications: either $1 million in net wealth that excludes their primary residence. In other words, so it can be all of your retirement accounts, separate investments that you have, cash that you have, anything except for the home that you live in, the equity of that property. Or if your earnings consistently as an individual are above $200,000 per year, with the expectation that your earnings will continue to be above that. For married joint tax filers, I think that it's $300,000 is the bucket for that. So that's how you can be considered an accredited investor. Now, those are the Regulation D deals. Regulation A is something that's a little more recent when it was introduced and opened up, and this is something that opens up investing through these crowdfunded real estate investments to non-accredited investors. So basically, the rest of us, right? So people like myself that I don't meet that $1 million or that earnings status just yet. So I still have access to invest through these. The main difference is that these Reg A deals, as they're commonly called, Reg A or Reg A plus, is there's a higher regulatory requirement for the platforms, for the REIT or for the legal entity that's offering the investment. They have to file semi-annual filings and annual filings with the SEC. And these Regulation D deals do not have to file disclosures with the SEC, right? So that's a major difference, and in turn that passes along higher costs for those Reg A deals to meet those regulatory requirements. It costs money to do that, so there's additional fees and structures that come into play. So those are the biggest difference between the Reg A stuff and the Reg D stuff.
And so for the Reg D stuff, I know that you generally have to commit a large amount of money. Usually, I believe it starts probably like between $10,000 and $25,000. So with the Reg A, it's a lot less. I believe it's as low as $500. Is that correct?
Yeah, that's correct, and it's orders of magnitude difference, right? So most of what you see with the Regulation A thing, these are REITs, so real estate investment trust. So it's a legal entity that owns multiple real estate investments. And it's typically they're kind of diversified across multiple properties or loans into multiple properties, that sort of thing. And the minimums, the lowest that I've seen continues to be Fundrise with a $500 minimum investment. A lot of the other REITs, are sort of $1,000. Some are $2,500 as a minimum. So even these can start pushing like the smallest amount might be pushing it for a lot of individual retail investors. But again, the reason why those limits are what they are typically is because the cost, right? It's expensive, and the more individual investors these platforms have, the more investor relations people they need to have, the more customer service they need to be able to provide, and those add additional operating expenses too. So that's why you tend to see the fees a little bit higher. Now on the Reg D side, typically what people are investing in is a standalone real estate development. Maybe a sponsor has identified and has a contract to acquire, let's say, an apartment complex, right? And that apartment complex is 30 or 40 years old, but it's in a really great area, but nobody's really invested any money in improving it in a very long time. And the sponsor sees an opportunity to do some renovations and improve it and increase the rents, right? And increase the rents, increases the cash flows, and then it could potentially create some opportunity a few years down the road to be able to sell that property maybe to an institutional real estate owner who's looking for the cash flows from it at a profit, right? So you might invest $10,000 is the very lowest that I ever see. Typically you see $25,000 is kind of the typical low, and a lot of the platforms like Cadre, for example, RREAF is another one that also does a lot of developing. They typically start at around $50,000. So those numbers can get pretty big pretty quickly. But you're investing in a project, right? This is the project. This is what it's going to cost. This is the returns that we're looking to generate from this project. This is who's developing it. This is how they get paid. These are all the fees. And this is what our expected exit looks like, right? So you kind of have this laid out path of how much you're going to invest, what you should be able to earn in terms of like dividends or distributions from the cash flows of the project, and then what the exit date is when the capital will be returned to investors, plus any additional profits that the deal makes when it closes and sells. So that's the difference, is that you have like a known targeted deal with a play out timeline. These Reg A deals, you're investing in a REIT that's kind of an in perpetuity thing, right? So you don't know when each individual property or deal is going to be exited. So it's a little less clear exactly what the strategy is for those individual properties inside those Regulation A deals.
Right. So you mentioned that there are REITs. So obviously people invest in REITs in the stock market. Is there a real difference between the two?
Yeah, so REIT, real estate investment trust, this is something that anybody that invests in publicly traded real estate companies should be familiar with, right? They get some tax advantages in terms of their cash flows, where the REIT itself doesn't pay corporate income tax. So that means more of the cash flows that it generates can be given to the owners, the investors, the shareholders of that REIT. And these Regulation A REITs, they work the same way. They get that same tax benefit. Now, the dividends that you pay, that you earn on a REIT versus compared to, say, like Coca-Cola as an example. Coca-Cola's dividends, you pay the taxes are paid at your capital gains rate. For most people, that's 15%. For the highest of earners, it's 20%. Now, the difference with the dividends that REITs pay is it's paid at whatever your marginal tax rate is, right? So if you earn $1,000 in dividends from the REITs that you own, and you own them in a taxable account, and you're taxed at the 25% marginal tax rate, then those dividends are taxed at that marginal tax rate, right? So that's how it works. Now, the difference, though, is that with REITs, you can easily own them inside a retirement account. Most of the platforms that offer REITs to the Reg A investors, they accept funds from self-directed IRAs. So you have the ability to own those in an IRA, and get that the tax advantage of not having to pay income tax on the dividends that you earn in that IRA. Now, most of the Reg D deals, they tend to be structured as limited partnerships or LLCs. Now, those have different tax implications. A lot of those entities still allow you to use self-directed IRAs, but you run into more tax complexity because there's things like unrelated business taxable income. It's called UBTI. That you could actually still end up, even owning it in an IRA, you could still end up with a tax bill. And plus, with these self-directed IRAs that are out there, the fees are a lot higher than your Fidelity rollover IRA or your E-Trade, Roth IRA that you might have on your online broker. There's additional fees that come in because it is more complex when you start owning these alternative assets in your retirement accounts.
That's a really good point. So if you're owning a Regulation A fund, do you have to do a self-directed IRA, or could you do it with a traditional IRA or a Roth IRA?
You're going to have to do it. It's going to have to be done with a self-directed IRA. And there's a lot of trustees out there that will do these that do these self-directed IRAs, and there are Roths and there are traditional for both. But again, the tax implications are tied to what you invest in, right? Whether if it's a LLC or a limited partnership, doesn't matter if it's a Roth or a traditional IRA, those tax implications could still be there. So my suggestion is that anybody that's looking to use a self-directed IRA to invest in anything that's a non-REIT, you need to talk to your tax professional before you buy that investment, before you invest in it. And it's very clear. You can see it in the documents that they provide, the legal documents that explain what it is you're investing in. You can provide that to your tax expert, and they can explain the potential tax risks based on what you're investing in.
Excellent. Thank you. And just to explain to people, a self-directed IRA essentially lets you invest in a variety of other assets. So there are some rules about what you can and can't invest with in self-directed IRAs, but it's essentially a way that you can use your retirement to invest in things outside of the traditional stock market. Exactly. So let's talk a little bit about your reviews on Millionacres. And you've reviewed bunch of these different platforms. So what were the factors that you started to evaluate first? Yeah, so the first thing is that I've learned over about a year almost at this point of reviewing these platforms is really understanding how the platforms themselves make money, right? How do they monetize the real estate investments? And really there's a lot of different ways that these platforms can make money that can vary greatly depending on what their focus is. Some of the platforms essentially act as marketplaces, and the deals that are offered, and this is pretty common in the Reg D space, where the platform does due diligence and some initial vetting of the real estate offering,
the sponsor, which is the developer that's going to be managing and developing the project. So they kind of go through that process of doing some initial due diligence. But the way that they make money can vary. Some make money. They collect a fee from the developer, right, to list that deal, and then they take a fee from the developer or the sponsor to kind of manage like the investor relations side of things. And then they'll also take a cut of investment. So let's say you invest $25,000, they might take a quarter of a point, right, as a transaction fee. And a lot of these, they tend to do that. They'll market themselves to investors as being no fees, right? And what they're saying is that you're not paying the fees directly, but these things are still capital. They affect the capital for the deal, right? Because whether the sponsor's paying or you're paying, there's a cost for that. It's just knowing who's paying it, right? I think you also tend to see most of these platforms will also charge an asset management fee. So it's an annualized fee. It can be anywhere from 0.5% a year to 2% a year, again, depending on the platform and depending on how involved they are. So you see that. So you look at like the transactional cash flows that they generate, and then you start thinking about other things too. So like you look at, say, Cadre, for example. Cadre, I think is a great example of one that's also really involved in skin of the game in terms of having exposure to every deal. This is a platform that actually takes a stake in every deal that's offered on its platform. Its executives take a stake in every single deal that's floated on its platform. And the reason this matters is because the platforms that only have exposure to transactional income of getting deals funded or getting deals on their platform don't have exposure to the downside risks, right? So when you think about it, there's a tension between due diligence and vetting these deals and how the platform monetizes it. And if the monetization, if you follow the money and their incentive is more tied to getting deals on their platform, then when deal flow is at risk, the risk is that deals that might not have passed their scrutiny a year before or 6 months before, when there was a lot of deals being marketed to them, the quality of the deals that are offered could potentially go down. But then you look at a platform that takes skin in the game and they invest in those deals, they have downside risk, right? They're much more aligned with investors in terms of losing money. And that can be a good thing to follow, to find the platforms where there's alignment between how the platform makes money and how investors make money, but also the risk of losing money. When that is a little more shared across the different stakeholders, it can I think it informs about due diligence and where the safer investments can kind of live.
I feel like that's really important right now, especially certainly due to COVID-19. We've seen all sorts of deals fall apart, and I feel that that's one of the things that may be really more important than ever. Absolutely.
I think we saw this in March. Most of the platforms, and this is something we'll talk about too a little more with the Regulation A investment offerings, is how do you get your capital back, if that sort of thing. Is we saw very, very quickly the Regulation A funds circled the wagons really quick and stopped any kind of like share repurchase plans they had or liquidity plans. They all basically they have so these are the ones that you're not investing in a deal, right? You're investing in a REIT that buys property with your capital and manages it and flips it and generates cash flow. Those funds, every single one of them has the right to refuse to return capital. You can send in a request for redemption or share repurchases, however they tend to describe it, and they can say no. They have autonomy to do that. So that's a risk that Reg A investors need to consider. And the point is that back in March, just about across the board, all of those Reg A funds, except for one, Streetwise is the only one that I personally saw that I reached out to, and the ones that were filing releases, the only one that continued to offer redemptions. Every single other one said we're temporarily halting redemptions. Now the good news is we've seen, it's been a weird recession, right? And money has quickly flowed into this space, and a lot like Fundrise has talked a lot about how they're really trying to target, be opportunistic right now. You never want to be a buyer or a seller in a buyer's market. And this is certainly a buyer's market, So there's a lot of capital that's flowed back in, and it's created opportunity that they're taking advantage of. So the risk, I guess, is that when we see the economic cycles and when we see real estate cycles, is you never want to be in a situation where you have a targeted date to take your capital out, and it just happens to correspond with an unpredictable change in the cycle that causes the REIT that you invest in to say, well, we're not going to do any redemptions right now.
Yeah, that is something that I think is really important for people to understand, that is when you invest in one of these, it's not like the stock market. You can't essentially panic sell. Not that anyone should ever panic sell, but you can't necessarily just pull out because you feel like it. And the times when you can take your money out and the amount of money you can take out and what you might receive back can definitely vary. And I know that's one of the things that you evaluated in your reviews.
Yeah, these are very illiquid investments. And I think even with the REITs that do have those clear redemption plans laid out, and typically the way they structure them is pretty interesting. And I tend to think it's smart, right? They build it so that they want investors to not even attempt to ask for redemption for at least 5 years. So they build them so that there's a scale. It's like a waterfall. If a lot of them, like you invest, you can't. They say no redemptions for the first year, and then between year 1 and 2, they're going to charge you 5%. I've seen some even say we're going to charge you 10% of NAV, which is net asset value, which is the per share value of the assets in the REIT. They're going to hit you with a 10% fee, and then between years 2 and 3, they're going to charge you 7.5 and 5, and then by the time you get to year 5, there's no more fees, right? So they really try to create financial incentive to prevent people from thinking about this as a way to tap liquidity. Because here's the bottom line: if you're a real estate developer, you have a project laid out, and it's going to take 5 years to develop it. You need the capital. You can't deal with sending people back money every few years and every few months and then scrambling to try and find more capital to complete the deal. That's why these businesses exist, and that's why there's opportunity, because they need predictable access to capital, and investors that have capital they can ignore for an extended period of time can profit from having that capital tied up in a great investment.
Well, and that brings up another point, is that when you've got your money in these funds, tracking it is a little bit different than the way you would track your publicly traded REITs or any other stock investments, because it's all takes place inside the platform. And I know that's one of the things that you've looked at inside the reviews, is reviewed some, like if they have a mobile app, or what how they report and when they report, because it can vary a lot depending on the platform that you choose.
Yeah, it can, and here's the other thing too, is that it also depends on what exactly are you owning, right? Because a lot of these deals, you might have an equity stake. You might not have an equity stake. It might be a hard money loan, right? You might be lending money to a developer, so that's closer to a bond, right? That's it's a loan, right? The value is the value, plus whatever interest and yield it's expected to generate, right? So, and then with real estate, what's the market value of the asset, right? There's that minus all the obligations and expenses and that sort of thing. So, you have a publicly traded REIT, and it's the true value should be underpinned by the value of those assets, but often the market value that day depends on what other people happen to be thinking it's worth, right? So it can fluctuate greatly. So the NAV, the net asset value, you tend to see reported for these assets is a lot more tied to a property. It's that's been evaluated. They know what it's worth, right? Because they know what it was paid for, and you know how much cash flows it generated the year before. You know what your operating expenses are. So that NAV doesn't fluctuate day to day because it's not traded on a public, a secondary market where there's this liquidity that changes the value on a day-to-day basis. So they tend to update that NAV, at least once a year. If there's been a material change, and they have to, they will update the NAV based on that material change. So there's all of these things that kind of come into play that can affect the value. But again, the biggest thing is because it's not liquid, the value tends to be, barring some sort of material change, far more consistent and stable. For the most part, these platforms are really good about filing quarterly reports to investors. So again, these aren't things that necessarily are going to go to the SEC. These are things that they're going to send to investors. If you own a property that's being developed, you need to know what's happened. Are they hitting the timelines? Are they running into problems? Are they having to change the plan based on, I don't know, maybe a global pandemic that might have thrown things off, right? So they need to keep investors informed of those things along the way. And typically what happens is one of these platforms is, they might have funded 3 dozen real estate deals over the past year. And through the platform, you have a dashboard where they manage the communications from the sponsor so that when you log into your dashboard, you get the information about the deal or deals that you have participated in that come right in, and you can keep up with what's going on. And they kind of manage that flow. For the REITs, the Reg A stuff, it tends to be a little more kind of like what you see from publicly traded companies because, again, they have to file with the SEC. So typically with that stuff, if they file it with the SEC, pretty often there's going to be a press release, and they love to send those press releases out to investors. Unless it's bad news, they might not send a press release, and they're only going to do an SEC filing. So you need to get comfortable with how to find the SEC filings for those Regulation A products that you might be invested in so you can stay up to date with what's going on.
That's a good point. One of the things I've noticed from Fundrise, I've invested a little bit with them just to test out the platform, is that they may exit a deal faster than they originally planned to. I've noticed that during the pandemic especially. So one of the things that is interesting with these Regulation A funds is they may say, we're going to hold this property for 5 years, but they may end up exiting sooner. They may end up exiting later. And I think it's important for people to understand is that you don't really have control over that. And that's really true with both the Regulation A and the Regulation D funds, is that the sponsor, the developer, is really in control of that timeline and will adjust it depending on economic factors or anything else that could happen.
Absolutely. And I think one thing it's with the Reg D deals, it's a little easier to know exactly what you own because, again, you're typically investing in a project. Now, some of them, like Cadre, they do offer these that are kind of a more managed investment sort of things. Like Cadre, you can give them $100,000 and they'll invest $10,000 of that into the next 10 deals that they fund through their project. So through their platform. So, but again, those 10 deals when they hit. This is the deal, this is the deal, this is the deal. When you invest in these Regulation A funds, Fundrise is a good example. Fundrise is gigantic. They're the dominant participant in this space with more individual investors than in probably the next 2 or 3 platforms combined. They're really substantial in their scale. You have the least amount of control of any of these platforms because you can't even pick an individual REIT to invest in. You describe who you are as an investor. If you're looking just primarily for income, if you're targeting capital gains, growth, or if you're looking more of a balanced mix, they're going to allocate the funds that you invest with them across multiple different REITs that are targeted to generate to focus on whatever your specific goals that you outline are. And that makes it even more complex because you could end up owning over 5 years of investing with Fundrise. You may end up owning a stake in 5 or 6 different REITs, and each of those REITs might own a dozen or more properties. So in terms of doing due diligence, it's much more challenging if you're really trying to have more control over your individual investments. These REITs, especially like a Fundrise, can be far more complicated to do. The point is that you have to trust management. I think that's what it comes back to. You have to trust the people that are allocating the capital to act in your best interest. And a big part of that, again, is figuring out how they make money. And that's something we've really focused on heavily, especially in our Reg A platform reviews, is looking at how the platforms monetize. One of the things that I've seen in a lot of these Regulation A REITs is you start getting into the filings and you find out that a platform, for example, they might be able to take a 2% transaction fee when a property is sold or 2% when a property is acquired. And that's not something they really talk about in their marketing at all. And what this does is this creates incentive for them to flip properties because they can take a cut. Even if that property is sold at a loss, they can still take that fee. Some of them will the construction might be managed, development might be managed by a closely held company that's a related party to one of the to the sponsor, and they might charge above market fees for construction, right? So these are things that you have to understand because sometimes I've seen some of these platforms, they've kind of gamed it. So even though they're disclosing it and they put it in those regulatory filings and it's there, 99% of investors don't crack those filings open and never know that even though they might say we only charge a 1% annualized asset management fee, that's all they charge you directly, but then the capital that's in the REIT, what they're paying, the fees that they're paying for the services that are provided can be egregious, and can structure it so that the sponsor can make money even if you as an investor don't necessarily profit.
So if you're an investor and you're starting out and you're interested in these, do you recommend going to the SEC filings? Do you recommend going to the platform itself? Where do you start?
I think it's a little bit of both, right? Because I think it's really good to hear what the platforms say, and that's what you see in their marketing and on their platforms. But then when you compare that to what they actually do, which is what they disclose in their regulatory filings, I think it can really be eye-opening. And that's one of the platforms that I really like a lot for Regulation A investors is called Streetwise, because what they say and what they do are incredibly aligned, and the fees, structures, and their process and their strategy, I think, is really aligned with creating the best value for all stakeholders. And then you start looking at some of the other platforms, and their engagement with closely held parties, so they're not having arm's length negotiations, as they call it, for things like they're not bidding out for a construction. They're just the sponsor, the guy that owns the sponsor, that owns the platform, owns the construction company, right? So you have these conflicts of interest with some of the other platforms. And frankly, I haven't seen that with Streetwise, and I think it's one of the things that's made me very impressed with their alignment with how they make money and how investors profit.
Well, and I think there's also a question of risk with these investments. They are, I would say, higher risk than traditional stock market investments in some cases. Mm-hmm. So I know that we've had a few of them that have run into trouble. Realty Shares a few years ago ran into trouble and then were purchased by another company. And I think some of the other crowdfunded Regulation A funds have run into trouble, especially recently.
Yeah, so Realty Shares is a good example. Actually, two of the existing large Reg D platforms, Into IINTOO and RREAF Holdings, formed a joint venture they acquired and formed a joint venture to manage the Realty Shares assets through liquidation and project completion to try to return as much capital as they could to investors. We've actually reviewed both of those platforms, and they're quite interesting platforms. Depending on, especially for conservative investors, they both have something interesting to offer. More recently, we've seen goodness, I'm drawing a blank now. It's Bricks REIT, which is part of the Rich Uncles collection of REITs. I think it was maybe a week or so ago, they just filed with the SEC that the Bricks REIT that the board has approved liquidating the assets. This is one that, just some quick background, if you were to ask me a year ago what I thought about this portfolio of real estate assets, so we own an apartment complex that's a university housing, and then we have a minority stake in another apartment complex that's university housing. We own a Starbucks that's on a university campus, and we've got a Gold's Gym too. And our debt to assets ratio is like 55%, which for the uninitiated, that's actually quite conservative. When you get above 60%, 70%, that's when it's viewed as a little more high risk. But 55% is a pretty good rate. If you asked me a year ago what I thought about that, I would have been like, yeah, that's pretty damn conservative. That looks like a pretty good investment. Yeah, that's Bricks REIT. And well, COVID-19 happened, and Gold's Gym went bankrupt, and universities said, well, we're just mostly going to be shifting to remote learning. So all of a sudden, just like that, all of a sudden the vast majority of your properties are generating, a rounding error from zero revenue. And then Starbucks tells all of its landlords, well, we want a year's forbearance of our rent. So, boom, you're talking about a black swan. And it's really sad. I was holding out hope they might be able to figure something out, but just completely caught. You went from a super dependable, great low risk asset base to liquidated, right? Just it's investors. I mean, if investors come out of this with pennies on the dollar, they're going to make out pretty good. This thing started out at $7 a share. It's either $5 or $7 a share was the initial net asset value. They reduced that to like 27 cents a share a few months ago. When all this happened, and said we're doing everything we can, but it doesn't look good. And then they just announced, like I said, about a week ago, that they're gonna liquidate. So I mean, it's sad, but investors just aren't gonna get much of anything out of this.
Yeah, that definitely is a stark example of how risky things can be. I mean, this year is an unusual year, as you said, a black swan event, and sort of hard to predict. I don't think that this year is necessarily a year through which you can evaluate how these funds, may do in the future. But it's certainly something to keep in mind, is that there is that extra level of risk with these investments.
And the big takeaway too is concentration risk, right? Because again, this is a REIT that owned less than a half a dozen properties. Mm-hmm. So there's several publicly traded REITs that have a commercial real estate and multifamily real estate property mix, but they have dozens or hundreds of properties that have university apartments and maybe own a Gold's Gym or two. That are fine, right? Because they're not so concentrated on those assets that are just immediately lost all of their cash flows. So that is another real risk to consider, because part of the Reg A Plus standard is they can only raise up to $50 million per REIT, per investment. So that by itself means that the assets are going to be more concentrated. I mean, that can create more upside, right, if they execute well, but it also creates higher risk from these just unforeseen kind of events like we just experienced.
Well, you mentioned the upside, so that's a good question. Who do you think these investments are really best suited for?
So I think if you look at the Regulation D investments, again, these are the individual deals. I think these are a great opportunity for accredited investors, and hopefully we start seeing, there become more will to start opening these up to non-accredited investors. I think these are great investors for anybody that is targeting a good mix of capital growth and some income along the way, that can invest in a looking to invest for 5 years or less, because most of these deals take 3 to 5 years from start to finish. They generate cash flows along the way, so you can earn some income. And then a lot of times those properties, once they're developed, there's a large investor that's willing to buy, that wants to buy because they want to own it for 20 years to participate in those cash flows, right? To get those earnings, the cash flow kickoff from it. So for individual investors, it's a great way to participate in these multi-million-dollar developments without having to come up with multi-millions of dollars and become an expert in developing real estate, right? It's a great way to invest $25,000, $50,000, $100,000 in one of these great projects and really generate consistent market-beating returns. Because over the long term, real estate development has been a great business, and you can predictably generate great, really strong capital gains and earn income along the way, right? For the REITs, for us Regulation A folks, it's a little more. I'm a little less sold on it right now because I think there's still because you have the risk of concentration. It's still really early. We're barely 5 years into these entities even being able to exist. There's a ton of people with tech backgrounds that have jumped in that don't have experience in real estate. There's a lot of people in real estate finance that have jumped in that don't have experience as real estate developers. And there's a few developers that have developed real estate through multiple market cycles. There's only a few that have done that. And some of those, unfortunately, have built the REITs with those fees that are buried in there that they can make money whether investors do or not, that make them less attractive investments. But the biggest risk to me is limited access to being able to get your capital back, right? So for example, Cardone Capital, the deals that they offer, these are 10-year deals, 10 years. Oh, by the way, it's a long time. Oh, by the way, do you know where they're sourcing the deals? They're buying minority stakes in Grant Cardone's personal real estate investments. So again, these are not negotiated deals. So you don't have that hand's length or that arm's length negotiation. 10 years can cover a lot of mistakes, right? So you really have to understand what you're investing in and how at risk and how hard your access to your capital could be. So that is my biggest concern, is because we're still so early. We don't have anybody that's really shown that they can, for 5-10 years, they can consistently generate capital, and then investors will have access to getting that capital back in a reasonable period of time. So that's the one thing that has kept me at this point from investing in any of the REITs. But I will say that I've been very impressed with the folks at Streetwise, and that's the one that I've targeted, and I will almost certainly be invested in Streetwise before, if not by the end of the year. I'd say within 12 months I will have invested in Streetwise. They have impressed me.
Nice. So you would say for people who are in our Regulation A bucket to, if you're interested, maybe just use it as you can try it out, but be experimental, and also really, it sounds like you really have to do your homework.
You do. So for example, like the biggest player in the space right now, Fundrise, the majority of their revenues come from originations, not from investor, or not from asset management fees. So again, they make most of their money from transactions, from bringing new deals in. So even the largest player, and they have a great reputation, and I think they've done a good job, and I think they're well run, and they have very experienced people that have developed real estate that are involved. But again, you have to understand, follow the money, and where they make money isn't completely aligned with where you would make money. And you have to explicitly trust management is going to continue to act in your best interest, even when it's not always aligned with what's in the best interest of that organization. So there's tension there that you really have to focus. And I think we just need more time for this to play out, to really know where the best players are and where the best opportunities to make money. But it has to be capital that you just have to go ahead and assume you're not going to be able to touch for a decade. Whatever they say, whatever the redemption policy is, you just have to go ahead and assume that you're not going to be able to touch it for 10 years.
Really good point. Well, this was fantastic. Thank you very much. And so just a reminder to everyone, you can find all of Jason's crowdfunding reviews on millionacres.com. They're in our crowdfunding hub. He is a very strict grader, and the reviews are very detailed, and they go into a lot of the questions that we've gone over today. And you could really take a look there. And then also, of course, as Jason said, do your own due diligence. Go to the platforms themselves, look at what they're saying, go to the SEC and look at the filings for each one before you make a decision. So this was great. Thank you. And thank you for tuning into the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. And if you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.